In today's video, I'm going to be sharing with you my 5 favorite boring dividend paying stocks that I absolutely love running the wheel strategy on. Let's go. Yo, what's going on, premium chasers? I hope you're having an absolutely God blessed day. Every single person that comments down below in today's video is going to get my full Ark Options Strategy playbook completely for free. That takes the wheel strategy to the next level. Just drop a comment and it's yours. And while you're down there, hit that like button and that subscribe button. But guys, let's get right into it. These are some of my favorite boring dividend paying stocks that also have some juicy premium associated with them. You guys already know I love running the wheel strategy, aka the Ark Options Strategy, on dividend paying stocks because as an option seller, assignment is a reality, and I love the double dipped income that I collect with covered call premiums, as well as collecting that dividend check as well. Let's go over the shoulder. First and foremost is Kenvue. This one recently got on my radar really for the past few months since Kimberly-Clark acquired them, and I've been having a tremendous amount of fun selling options on this thing because the premiums are fairly nice. Now, we could see right now Kenvue is actually not in like a great setup formation. It is below some key moving averages of the 200 and 300 day moving average. So if you like the stock, it's still pretty good. But as we know, it is a little bit overbought here on the RSI of 55 and trading in that upper Bollinger Band area, which for me, it's better to be patient. And taking a look on the options chain, let's go take a look at what kind of premiums we're collecting right now. We'll just go out about, let's say 37 days and see what kind of premiums. Let's go out 30 days and see what we're collecting right here on the options chain. So the bid-ask spread is just absolutely so massive here, but we'd collect around $98 of premium here. Now that is obviously, we're playing a little bit more aggressively here, right? With a Kenvue playing close to the money, and obviously we would be locking up $1,600, obviously a higher chance of assignment, but that's personally why I like to personally wait till we're at the lower Bollinger Band areas to sell my cash secured puts. When everybody's being fearful and selling off the stock, that is oftentimes the best time to sell your cash secured puts, as you know, you're being very oversold on the RSI. And plus, Kenvue also has a very nice dividend as well. The next stock is Ford. I've mentioned this one a few times on the channel, and I love Ford because even though recently it's had a nice little run up, it usually doesn't do much. And for the wheel strategy, like, I personally want boring. I want boring companies. They have a nice dividend payer, gives me a sense of security as well. And even with Kenvue, I love the fact that they own a lot of consumer brands that gives me a sense of diversification. So taking a look at Ford, let's go see what kind of premiums Ford is actually offering right now. And we'll just kind of keep it the same around that 30-day expiration mark. You can try to do like weeklies and stuff on this, but you're going to be playing closer to money. So if I just go out like 9 days, like even if I'm doing like the 13 puts, I'd be collecting, let's see what the bid-ask spread is. Oh, that's tight. So 19.20. So we'd be collecting, let's just say $19 of premium on that trade if we went out. Actually, let me delete this as it is from the last video. So we're collecting about $19 of premium, and we're locking up $1,300 and collecting about a 1.5% return on our collateral if we ended up taking that trade. Obviously not financial advice. Results value premiums are always constantly changing, as you guys see here, but we'd essentially be locking up $1,300 right on this position and collecting $19 of premium up front. That's from the silly little options buyer, and that's only in a 9-day period. To make that kind of return is pretty solid in my personal opinion, especially in a 9 days to expiration. But we got to talk about the risks, guys, because us as premium chasers, we are taking on risk. And what are those risks? Well, number one, if I executed this trade, right, and let's say on the 12th at close, right, Ford is trading above 13. Well, I'm not having to buy the shares. I'm not going to have to buy my 100 shares of Ford, my $1,300 that I had secured to buy those 100 shares. I can then go and, deploy in a different opportunity, right? But the second thing that can happen, this is the biggest risk when we are doing the cash secured put strategy, is that let's say on the 12th, right, this thing is trading below, right, $13. Let's say it's trading at $12, $12.50. You're buying your 100 shares at 13. That's always the big risk with doing this strategy. But in my personal opinion, if you stick to good quality names, right, you lessen your chance of getting hurt, right? So for example, like most people do this on like leverage ETFs and stuff. Obviously the gains are insane on leverage ETFs, but you're also taking on some massive risk, right? And your premiums obviously will be higher the further out you go with your expiration. So here, if I go out 30 days, right, I would obviously collect way more premium, but I also get a better strike price. This is why I often like to, at least on these dividend payers, I like to go out around 30 days for the most part. I do some weeklies here and there. I am currently actively doing a weekly on a more of a growth stock. But right now, like when I'm doing just boring dividend stuff, I'm usually just letting it ride for like a 30-day period. So in this case, I'd personally do like a 1250 because I'm just trying to stick to a delta between 20 and 30. I like to mix in assignment and non-assignment. Most of my stuff I'm closing out early anyway, or I'm just letting it expire worthless, okay? Very rarely am I having to take assignment. It happens, it's part of the game, but rarely do I. So in this specific trade example, we have to go back. Let me just refresh this and see if it shoots this. But you can see we collect $17 of premium here. If it lets me click it, there we go. Let's see. All right, it's around $17 of premium, but we're now locking up less collateral. And to me personally, this would be the trade that I would do. Yes, I'm collecting less return here, but I'm getting a better strike price as well. It all comes down to whatever your specific risk tolerances are and how badly you want to get assigned. If you really want to get assigned, and then you could start running those covered calls and collecting premiums, playing close to the money is obviously going to give you a better return, just a higher chance of assignment. All right. Next one is Pfizer. Listen, say what you will about Pfizer, but I really, really do like Pfizer as a company, and they offer some great dividends. Let's see. We're seeing a nice green open here today, up over close to 2.5%, and we are trading towards this top of this Bollinger Band. So we'll see if we see a nice bounce back towards our 300-day or 200-day moving average. So we'll see. This thing has been kind of ping-ponging back and forth, which is good, right? When we see a lot of this ping-ponging back and forth, we see a lot of volatility. This often gives us a lot of more premium than we would normally get. The higher the volatility, the more premium that we're able to capture from these stocks, right? And usually for me, kind of like my rule of thumb is I like to be below the 200- and 300-day moving averages. It gives me a sense of security as opposed to, not having the not having like I don't want to be at all-time highs, guys. Basically what I'm trying to say. I'm not selling puts at all-time highs, right? Like I want to be next to key support levels. And usually for me as a long-term holder, the 200- and 300-day moving averages are great indicators of where I would ideally like to be assigned, preferably below it, especially when we look at like a Ken view here. Look how far below the 200- and 300-day moving averages we are, right? And even, Ford, you could see has been on a bit of a run. You can see how above the 200- and 300-day moving averages are. And then here, with Pfizer, right, we're just playing right around those 200- and 300-day moving average. So let's take a quick peek at what we're seeing with Pfizer here in terms of our premium. So we'll go over to our trade options. We'll sell a put here, and let's go take a look at what the 30-day ones look like here. We're collecting, not insane amounts of premium, playing close to the money here. With the 25 puts, we're collecting. Actually, that's a fairly wide bid ask. So we collect, let's say, about $40 of premium. I always like to go between the bid and ask, especially look at this. The ask is $58. That's $58 of premium to collect. If you just did a market order, you'd only collect $22 of premium. Like that's terrible. You usually want to set a limit somewhere in the middle. So if I did this trade, I'd be looking at least at 40. I'll just again try to be I want to maximize my premium that I'm collecting here, especially if I'm locking up, right? $2,500. I want to be rewarded financially for taking on that risk. And you can see my return here is about 1.60% in a 30-day expiration time frame. Okay. And that's again totally how aggressive you want to be. Now, these again are boring companies. These aren't going to be your 3, 4, 5% ROI on your gainers for you, right? They can be, especially when they're selling off really fast, especially right now. With Pfizer, we're not seeing great put premiums right now because we're overbought right now. There's obviously this thing is trading towards its top Bollinger Band. It's above its 200- and 300-day moving averages, right? So the put premiums aren't as juicy as they would be if there was a big downturn. For example, right here when Pfizer was at 23, your 22 premiums here were probably insane, and that's where you were probably getting about a 2 to 3% return on your collateral. Rule of thumb: sell your puts at the bottom Bollinger Band, sell your calls at the top of the Bollinger Band, because usually it's not always happen. We see a nice bounce off of those levels, and then we're able to close out our positions early, and that's how I primarily use the Bollinger Bands. Next one is probably one of my absolutely all-time favorite ones, and that is Altria, playing right between really for this entire month of November and into December now. working its way up slowly, but right around that 57, using really the 300-day moving average as a support. Not really able to cross over its 200-day moving average, but this is a great stock. A little bit more expensive. We're locking up a little bit more premium, but you know, in my personal opinion, like this is a stock I'm proud to be a holder of. I am not stressed about holding Altria by any stretch of the imagination. So taking a look at some of the premiums that we're getting offered here, obviously they are higher because we are obviously locking up a lot more collateral here. And also, I didn't mention, guys, if you do want all of my calculators here that you're seeing, my cash secured put calculator, my trade logs, all these premium calculators, click that first link in the description of today's video. That's given to give you an hour-long training on the Ark Options Strategy. And at the end, I'm going to give you completely for free all of my calculators so you can actually go and implement this stuff for yourself, okay? So Altria, another one. We're not going to necessarily go in and like fill out the calculators right now. I think you guys can do that for yourself. But this is a great dividend player, great fundamentals of this company. Obviously, go do your own research. And then another one of my all-time favorites. You've heard me mention it many of times, and that is Verizon. Right? Had some very nice plays recently with this, with some puts and calls really, not really getting even assigned. Actually got assigned once on this, and just I'm probably going to get called away coming up here soon. But was able to do some really nice plays on this over the past like month or two, selling cash secured puts at the bottom, right? And then riding the wave back up, selling puts as we work our way back down. And again, just staying below those 200 and 300-day moving averages, which is where I really like to be. And this thing took a big tumble at the start of October, and that's when it got on my radar. And I was selling really puts since and kind of rode it down. And that's the name of the game, right? Eventually, if the fundamentals of the company haven't really shifted that much and you still have your thesis about why you like this company, usually these are short-term overblown reactions by the market, but that creates for us option sellers a tremendous amount of opportunity to take advantage of and then ride that wave back up, leveraging our covered calls, collecting the premiums, and then eventually selling those shares for a nice juicy appreciation profit. Guys, if you enjoyed today's video, make sure to attend the Ark Options Strategy. That's going to take this video stuff in this video to a different level for you. And at the end of that training, I'm going to give you my trade logs as well as my premium calculators. Click that first link in the description of today's video. Guys, remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.